Want to see someone systematically disprove everything you have read about trading stocks and expose how and why you will consistently lose money if you aren't doing it right? Click the link in the description to check it out for yourself. But now for today's video.
The question, what is the most profitable time frame in intraday trading? Answer by Santoshi Chawla. There are different form of traders with different trading strategies trading the market using different time frames. Short-term traders are using lower time frames like 5 minutes, 15 minutes, 30 minutes, hourly charts mostly, and medium to long-term traders prefer higher time frame charts like daily, weekly, monthly. Today we'll focus on the usage and significance of all these different time frames in your trading style and how your trading result can be impacted for choosing which time frame you use. As we all know, there are only two ways a trader can approach the market: intraday trading or positional trading. Intraday trading, when you buy and sell on the same day, your trading style is known as intraday trading. Positional trading, when you buy today and hold the position overnight at least for a day, your trading style is known as positional trading. Positional trading can be with different types, like some traders hold a position for 3 to 4 days, who are also known as swing trader, and some holds a position for weeks, months and even years are usually known as medium to long-term traders/investors. So it depends on the type of profit target and trade setup you have for the trade you initiate. Now, another special category of traders you'll see in the market who is neither a positional trader and nor an intraday trader. It always depends for this category of traders to decide what is their trading style based on their current trade position, profit/loss status. They buy something with an intention to have an intraday trade, but finally at the end of the day, when they see their position is a huge loss or against them, they convert themselves into positional trading style and hold the position for next day with ultra extra leverage on it, with the hope that tomorrow will be our day to profit and the stock will turn around for us. Finally, market kicks them out of their hold position with huge amount of losses. Being a trader, we must know our own trading types. Either you are a positional trader or you are an intraday trader. If you're a positional trader, then you must know for what time frame you hold a position: short term, medium term, or long term. Rules for your trading style or strategy must be set before you enter a trade, and more importantly, you must know what you're doing. Personally, I am a positional swing trader with an average holding period of 3 to 4 days. I use 70% of my trading capital for swing trades, and for rest 30% capital I use for positional trades, which I hold for average 3 to 4 weeks or more. I do not prefer trading intraday, and in short you can say I hate the concept of intraday trading. Now this article is based on why I do not like this form of trading, and I'll be explaining you the limitations, loopholes of intraday trading and why it is a killer/enemy for your trading career in long run. In my trading career, I've never seen the big boys, banks, HNIs, etc., doing a single trade with the hope to make money today itself, intraday, and it was shocking for me when I joined them, as till then I was struggling to make money by doing intraday and tried all my skills and materials of technical analysis to dig out consistent profits on the same day using any possible intraday trading method. And in my experience today, I can definitely say more than 90% retail traders are looking for something which will make money for them on a daily basis. I receive mails and phone calls asking me how much we can make per day. So why this intraday trading is so lucrative to retailers? Reason 1: greater than you get 10 to 20 times leverage on your trading capital to trade more. Using the margin facility, you can buy more than what you have, and without thinking about the other side of profits while in loss, you start using this charming facility of leveraging in the best possible way and finally end up losing all your capital. Reason 2: greater than it feels good and exciting to make money daily and instantly. A gambler is allowed to get excited with his bet, win or loss, but never for a good trader in market. For a trader, trading the market is not a one-day show, but for a gambler it is. Now, it's up to you how you prepare yourself as a gambler or a logical trader. Reason 3: greater than no worries of what will happen tomorrow regarding a crash of market. And so, in business, you always have a business risk. What if your clothes store and market gets a fire tomorrow, or what if there is an earthquake tomorrow and you lose your Rs 5 CR worth of investment in a building? So, all these accidents are a part of our life, and thanks to Allah that it doesn't happen in every other day. But still, we'll have to be prepared for all of these in life with proper planning and calculated risk. You must know if something wrong goes tomorrow which is out of your control, what will you lose and how to manage that. But if you do not calculate your risk factor and buy 10 lots of shares keeping Rs 50,000 in your trading account, then any of this sudden accident can finish you up for rest of your life, and we can see how many suicides take place after each crash happens in market. Most of them you'll see are stockbrokers who gave 10 to 20 times margin to their clients so that the clients trade more and the broker can make more commissions that way. But when a crash happens, all his clients are in heavy losses and now he'll have to collect the extra money of losses which is not available in clients trading AC from each of them, which is a liability of huge amount. He just cannot handle this pressure of liability and finally kills himself to remove the burden on him. Reason for greater than it feels good and exciting sitting in front of the trading screen and watching the price moving up and down. This process is a good way wasting your time and energy, and also it shows that you have a no planned strategy to trade when you are waiting for the market to open and rushing into a trade, then roaming around the trading screen with different level of excitement with your position with a psychological roller coaster ride in you. Apart from above reasons, there are a lot of other stupid reasons why retail traders are so much fond of intraday trading, and all those reasons really make no sense at all. Let's find out the reasons why we should avoid intraday trading, and here I'll explain using one of my trading strategy covered in advanced price action course. Problem 1. Time limitation. Whenever we initiate a trade, as a disciplined trader we all have a strategy with a stop loss and target in place. But there is no such strategy which can define the time period of hitting your stop loss or target area. For example, in below chart you can see a bearish pin bar sell signal formed in line with the strong sell-off momentum on 16th Jan around 10 p.m. in hourly time frame. Since we got a support area in daily time frame around 175, this level will be considered as target area for this trade. Now, we're ready to hit the entry in this trade using our most important trading tools, money management tricks and risk-reward ratio calculation. Now, below chart will show you the final trading result of above discussed trade from an intraday trader and positional trader perspective, which will clarify you that why using the same strategy one person is a winner and the other one is a loser. Someone who is shorting natural gas with ultra leverage for making the profit on 20th Jan itself has ended the day with a loss as price did not react to the sell formation on that same day. The intraday trader will have to close his open position as commodity market will close by 11:30 p.m. and now the time limit will decide his fortune and not the trading strategy setup. On the other side, someone who shorted natural gas on a swing trade basis with a holding capacity of 3 to 4 days has made good amount of money finally as he was able to execute his trading plan properly. So it shows with the same strategy and planning, someone loses money and someone makes money in this market. I shared this trade setup in blog for daily time frame, though I did not share the intraday chart there. So I was trading intraday chart which was in line with my daily chart setup, but I did not initiate the pin bar sell position in my AC to do intraday only with huge leverage, but it was being traded as a swing positional trade. Below I've shared one more example on the same natural gas chart where you can see the same things happened like earlier. The trade finally has hit our target area after entry, but leaving behind all the intraday traders at loss who was just trading for the day. All the swing traders got the chance to ride the whole sell-off momentum and finally ended up making money. Same happened below on ACC stock. Buy signal based on pin bar formed on 9th and price pushed a little up. But the major bullish momentum arrived on the next day of entry day and hit the target on 2nd day from entry. Again with the same price action strategy, an intraday trader lost in a swing positional trader won. Problem 2. You need to be a professional / expert / experienced trader for reading intraday price action to catch its momentum greater than. I've seen people who are beginners or learners yet in market, start analyzing lower time frame charts like 5 minutes, 15 minutes, 30 minutes, 60 minutes and totally ignore higher time frame charts like daily, weekly, monthly, as they think following lower time frame charts, they'll be able to catch more number of trades and will trade more frequently in a day, making more money. This sort of mindset of a trader is nothing but a killer for his trading career. When you start to learn how to drive a car, or when you've just learned how to drive a car, which kind of roads do you prefer to practice driving, or which kind of roads will you prefer to drive regularly for first few days? Obviously you'll choose roads which are free of much traffic, and you will definitely ignore rush hours to drive on the road. The same goes for trading. When you are analyzing intraday timeframes on live market, it's like driving a car in a heavy traffic area in extreme rush hours, as you will find more candles, patterns and trends forming in a very short span of time, and shift of trends with patterns are very fast and frequent there. But when you start seeing a higher time frame chart, you'll see a clear price actions with candles, trends and patterns over there, and also you get sufficient time and energy to devote for analyzing the chart, as only one candle is formed in a day for daily chart and so on for weekly, monthly. Hence trading or analyzing higher time frame charts are like you're driving your car on a road with piece of less traffic and no rush hours. Below is a chart showing you how it looks like in a 15-minute time frame chart, as the above chart shows no clear direction of the market and too much noisy while trading http:// It takes no time for price to reverse there and change its direction with patterns. But the same index chart below, in a higher time frame weekly, shows us a clear picture of the overall uptrend strength, and it also formed a price action buy signal on a key flip support area of 8,200. So, higher timeframes always provide you the neat and clean price action to have a clear overall direction in the market. Below is another example of confusing intraday chart with 15 minutes time frame. What you see here is nothing but some zigzag momentum going on overall, and there's nothing really to trade as do we have a clear direction here. The same stock, while analyzed on a daily time frame, gave us clear view on the trend and a trade setup. The equidistant trend channel show us clear uptrend direction, and 1130 level is seen as key flip support where we can initiate a buy entry based on price action signal to join the bullish up move, and currently we can see price heading towards our resistance target area. I personally trade 5 minutes, 15 minutes, 60 minutes charts in lower time frame and daily, weekly, monthly and higher time frames. So, I am not against trading lower time frame or intraday charts, but only thing I am saying is that there is a way how you do it. Our focus chart or the mainstream chart should be higher time frame charts, as those charts shows us the overall picture regarding what's going on in the market, and to have an early buy/sell entry or to filter out higher time frame price movement, we come down to lower time frame charts and trade accordingly. But even though we're analyzing or trading a 5-minute chart, there is a connection of daily/weekly chart with this 5 minutes time frame, and we're just not trading a 5-minute chart alone. Like in first few chart examples I've shared with you, my entry was in 60-minute chart, but I'm exiting the trade on support areas of daily time frames, and also while taking an entry in 60 minutes chart, I've decided to trade that 60 minutes chart as I've seen something powerful in its daily time frame which confirmed this trade setup in 60 minutes. Finally, it's all about trading and analyzing multi-time frame charts, which gives you a better edge in your trading strategy. But to learn this form of trading, one should start with higher time frame charts first, and then once you are good in trading those charts, then only it's time to have a look on lower time frame charts. So, you need to be a real expert or experienced enough with higher time frame chart analysis first to understand price actions going on in lower time frame charts to trade. Like after driving a car in a broader, less traffic, non-rush hours for 3 to 6 months, you'll gradually learn to drive in full traffic road in rush hours due to your experience and time spent with handling the car. I'll not extend the article anymore, though I've plenty of more reasons why intraday trading habit is a bad idea. Hopefully, I'll create another lesson on multi-time frame chart analysis for better chart analysis in next few weeks once I manage some time for my trading desk. Try Swastika InvestSmart Limited to manage your wealth profile. Click here to open an account or feel free to contact us. Answer by Ashok Devanampriya. There is no ready-made answer for this questions. It completely depends on the strategy you are using. BTW, I am running an 100% automatic algo system on a 5 minutes candle on an intraday basis across some 110 futures stocks. Thanks, Ashok Devanampriya. Kautilya Capital. Answer by Shakar. It is difficult to say about intraday. If we consider 1-day time frame, then the time would be when market volume goes up. The final hour is the time market goes up. European markets open, most of the information would be out. So 2.30 onwards is right time to enter to square up the same day or next day.